What's up, my bulls and bears? In this video, we're going to be discussing the venture capital sector. Let's get started by looking at a definition of venture capital before moving on to its structure, how venture capital businesses earn money, their investing techniques, and finally, job opportunities in the sector by examining factors like the hiring procedure, necessary talents, and other factors. So what exactly is venture capital? Well, venture capital, simply put, is money given by investors to startups with significant growth potential. In return, that startup will grant them an ownership stake, either common stock or preferred stock, in their business. Now, check out my Stock Market for Beginners video, which I'll include a link in the description box below to learn the distinction between the two. In essence, the VC anticipates that if the company grows, so will its value of its equity share. VCs then eventually intend to be able to sell their equity share for more money. Now, from a larger perspective, venture capital isn't really something that regular people like you and I would invest in because it's generally included in the category of alternative investments, which also includes things like real estate, private equity, hedge funds, and a couple other investments. Instead, it's primarily for professionals in the business. Also, in terms of the risk-reward trade-off, it's undoubtedly among the highest risk and highest return investments. And for the majority of alternative investments, that's usually the case. Now, in the venture capital space, the majority of companies that VCs invest in actually fail. But that's okay, since all the VCs are really looking for is one big home run to make up for all the losses. It is undoubtedly high risk and high return because just 1 in 10 investments actually succeed. Its perceived danger is also attributed to the fact that these are illiquid investments. Liquidity is defined as the ease with which anything can be turned into cash. Now, here's the liquidity skill for you. See, stocks in large corporations, such as Apple or Amazon, are among the most liquid assets since everyone buys and sells them, and it's actually quite simple to locate a counterpart who will be satisfied with your price to purchase or sell. On the other hand, real estate is among the least liquid assets, because the ability to buy or sell a home sometimes takes years. This is due to the large number of parties involved in the process, for things like numerous contracts, rules, and other factors. Now, definitely on the more illiquid end of the scale is venture capital. This is primarily due to the fact that once you invest the money in a venture capital fund, the money is shortly invested in startups. Therefore, the money can't really be withdrawn or recovered until the startup has actually performed. Now, moving on to the structure of VC funds, there are going to be 2 main contributors, or 2 main categories of people that are going to be putting in their money. First, the venture capital firm itself, also known as the general partner. And second, investors, also known as limited partners or LPs. Institutional investors, such as insurance firms, endowment funds, and other similar organizations, typically make up these LPs. However, a small fraction of the fund's capital will come from the general partners in order to align their interests, ensure that they have some skin in the game, and stake in the outcome as well. The limited partners, who are institutional investors, will contribute the vast majority of the fund's capital. And when the fund has raised the full amount, it will invest in various startups. By the conclusion of their investment horizon, most VC fund investors will anticipate returns between 25 and 35% each year. Now, having said that, they do not typically anticipate that return from every single company. Rather, 1 or 2 of them will typically be a home run. So if they have that 400% return on the home run, while the other have nearly nil, they will ultimately have a 25 to 35% return balance. Now, the pay for the VC is often divided into 2 components. The management fee, which is usually a fixed fee of between 2 and 3% of the assets under management, comes first. This money is used to cover operating costs such as employee compensation, office rent, and other costs. This portion, however, is guaranteed, so regardless of whether the fund is up or down, they will still receive the same sum of money. On the other side, there is something called a performance fee that is linked to the company's profits or success. Basically, how well and how efficiently the VC fund is operating. The venture capital firm typically receives 20 to 30% of this performance fee, while the remaining 70 to 80% goes to the investors. However, the VC funds only realize these performance returns when they sell their investment, which is when they leave the position. A VC firm can exit a position in one of 3 ways. The first of which involves an IPO, which is arguably the most attractive exit. It stands for an initial public offering, which is when anyone in the public, like you or me, can purchase the shares on the open market. The second possibility is an acquisition, like the purchase of LinkedIn by Microsoft. The third is when you sell it directly to another venture capital firm that concentrates on later stage startups. Next, let's examine the investment mandates of VCs. In the venture capital sector, the majority of funds specialize in specific timings or stages of a company, as well as specific industries and locations. In terms of timing, these are referred to as investment rounds. Usually, it will begin at the pre-seed or seed stage. This is essentially when a business is still in the idea stage. The next stage will be a Series A, where businesses will begin to develop their products. The Series B then follows, where businesses aim to increase sales and expand. Then, aiming to scale the business and make it successful, Series C and later rounds are available after that. Then finally comes the IPO, occurring when they sell their shares on the open market. And it's also critical to remember that ideally, both the money raised and the overall worth of the company increases throughout the rounds. Now, other parties are generally participating beside these VCs. Typically, there'll be other private equity funds participating, more specifically growth equity funds. You might even have VCs or growth equity funds that are sub-industry specific, things like technology itself, like biotech, financial technology, educational technology, and etc. And the last criterion is location, which, to be honest, should go without saying. However, there are some significant funds that don't necessarily have specific concentrations or locations. One of the largest VC firms in the world, Sequoia Capital, for instance, covers the majority of the world's geographical areas, according to their website. Next, let's examine the industry's job opportunities. There is generally a hierarchy in the venture capital world, and it's as follows. You have an analyst, associate, vice principal, principal, and then partners. And there even could be further subdivision into junior and senior roles. You might have a junior associate or a senior associate, for instance. And although the analyst role is generally the lowest level, it's typically not for those who are fresh out of college. Rather, it's for those who have perhaps 2 to 3 years of experience working at either a consultancy firm, a bank, or a large tech company. Although it's not very common, it is possible to land a job right out of college without much experience. Generally speaking, depending on how much experience a person has, they can either be a pre-MBA or post-MBA candidates for the associate level. And then moving all the way up to partners, they're usually the ones that have money invested in the fund personally. So this isn't really a normal job for them because you can't simply stop working whenever you feel like it. It's also extremely useful for partners to have experience as entrepreneurs themselves. If you look at a case like Reid Hoffman, who's a partner at Greylock, he was also the co-founder of LinkedIn, which was later acquired by Microsoft as we discussed earlier. Now, some VCs also have a unique position known as the entrepreneur in residence, which doesn't exactly fit into that structure. This is typically an ex-entrepreneur who provides advice to some VCs' portfolio companies, or may even take on an executive position at some of the startups. Now, the size of the fund and the quantity of the deals that they're receiving are definitely relevant factors when it comes to the hours. However, a common rule of thumb is roughly 60 hours per week, which is probably better than the 80 hours you might work at an investment bank or the 70 hours you might work at a management consulting firm. It is roughly comparable to the 60 hours you might find at a large tech company. However, because it involves a lot of networking and other social activities that some people might consider work, some might not, these hours can occasionally get hazy. Now, looking at a junior employee's time, it's often spent conducting research to evaluate the most recent business trends and look up information on intriguing businesses, as well as analyze and interpret new deals that come through the pipeline. Additionally, a significant amount of time will be devoted towards networking, which you'll be speaking with startup founders and other management. You'll also be looking at business strategies, which involves determining whether a given startup's business model is one that will be successful in the long run. Then, last but not least, although perhaps a little bit less formal than a traditional finance function, it's pretty typical to use spreadsheets on a day-to-day basis to try to evaluate things. Now, if you're looking for some more information, I'll provide some links to some worthwhile publications in the description box below so you can learn more about the venture capital ecosystem. Thanks everyone for watching, and if you enjoyed this video and want to learn more about the venture capital market, investment banking, stock market news, and anything else investing, smash that like button, hit subscribe, and leave a comment below with the topics you'd like to see us cover next.